Okay, so apologies for the abrupt ending in the previous video. Those technical difficulties. So where I left off, I was starting to prepare the schedule cost of goods manufactured. So we're preparing the previously mentioned schedule, the schedule of cost of goods manufactured for the ABC Manufacturing Limited for the period ended December 31st, 2019. Okay, so if we refer to our notes, the first thing we have to find is the prime cost. So, whoops, my bad. Right, so the prime cost. So this is the first section here. So, as we said even earlier in the lesson, in order to find prime costs, we have to find the total of direct material, direct labor, and direct expenses. Okay, so I gave them to you. So, but we have to do a little working for the direct material. So I said that beginning direct material inventory brought forward is 10,000. So we would have to add, so this was direct material that we had in inventory that wasn't used in the previous period that we brought over to this current period for use. And the next line item here is that we have direct material purchased. So this would be a direct material that we would have purchased during this period for use during this period. Okay, so I said that was 100,000. So we add the two of these. So when we add our direct material inventory brought forward to our direct material purchase, we would get our total direct material available for use, which would be 110,000 in this case. Now, so we need to deduct what we didn't use this period, which would be our direct material inventory carry forward, and it had a value of 20,000, so I deduct it. To show subtraction, I use angle brackets or the more than less than sign. You can either use this or you can write the word less before it. It really doesn't matter, all means the same thing. So basically deducting one thing from the other. So when I deduct that, that's going to give me my direct material consumed, which means 90,000. So now we have our direct material as one piece of the puzzle. So the next thing we need to do is include our direct labor, which should be 20,000. So in this particular example, we didn't have any direct expenses, but if we did, we would include it in this section as well. So our direct costs, our direct labor, and direct material. So when we add them together, this will give us our prime cost. And this is in accordance with our notes, as we said here. As I said before, we didn't have direct expenses. In this example, we just had direct material and direct labor. Okay, so right, this will give us our prime cost. So we have the first piece, and the first item in our equation here. So the next thing, according to our equation, is that we need to find our total manufacturing overheads. So I gave you 4 overheads: factory depreciation, factory insurance, factory maintenance and repairs, and indirect labor. The ordering of these line items doesn't matter a great deal. If you prefer, you can order it in similarly to the prime cost section, where you have the indirect material first, then you can put indirect labor and then other indirect costs. But as I said, it doesn't really matter. All is the same thing. Okay, so these are the values I gave you. So let me add these together. This will give us our total manufacturing overheads, which should be 9,000. And then according to our notes, once again, because the schedule follow these equations, two equations I gave you. So we already have our print cost. We said it was 110,000, and we're gonna add our total manufacturing overheads, which is 9,000, and that should give us our cost of manufacturing. Okay, as I have here, so our cost of manufacturing is 109,000. Okay, so according to our notes, the next piece that we need to get, so after we determine our cost of manufacturing, we need our net work in process. So as we said earlier in the lesson, net work in process is any work that is incomplete. That's why I have this section titled incomplete work at the end of the accounting period. So if you think about it, especially if the process has been going on for quite a while, we would have two types of work in process, similarly to the direct material inventory. We would have a brought forward and a carry forward. So the brought forward would be the incomplete work at the end of the previous accounting period. So we would have not have finished it at the end of that period, but we brought it over to this period to be finished. Okay, so that in this case is 5,000. Then we have the closing work in process, which is 4,000 in this case. So this would be work that we started during this period, but wasn't complete at the time of the end of the accounting period. So we have to carry over to the next period to be completed. That's where we're deducting. We're only accounting for what was actually manufactured during this period. That's where we're adding the brought forward, because this would have actually been completed during this period, and subtracting the carry forward, because this will be completed next period, not during this period. Okay, so we will deduct the two of these, and we will deduct the closing from the opening work in process inventories, and that will give us our net work in process, which is 1,000. And now, according to our notes, once again, we would add this to our cost of manufacturing, which would give us a cost of goods manufactured. Alright, which is this last line item. This is our final item in the schedule with double underline. So our cost of goods manufactured is 120,000. Okay, so that's done at the end of that statement, that schedule, sorry. So the next schedule you have to prepare is, according to our notes, the cost of goods sold. So we headed up similarly to the previous schedule. Just we will change the terminology because it's a different schedule. So the only section would be the cost of goods sold, because that's what we're trying to find. So we have our finished goods inventory brought forward. So this would be the finished goods that we had in the previous period but wasn't sold. So we still have it for sale this period. This is 40,000. Then we would bring our cost of goods manufactured value from the previous schedule here, and we're going to add it to the same value, 120,000. We're going to add it to our finished goods brought forward inventory, and that's going to give us our cost of goods available for sale. Because if you think about it, the goods that we didn't sell at the end of the last period, we wouldn't discard them. We would keep them for this period for resale. So what we would actually have available for sale would be the combination of the ones we started and completed in this period and the ones we started last period and completed this period. So that's what this 160 represents. So then to determine what we actually sold this period, we would deduct how much we have left. So what we didn't sell, which was 50,000 in this case. So that would give us 110,000 as the goods sold. Okay. And the last thing we have to do is our income statement. So let's just look at our notes. So now income statement, once again, two main formulas. So we have the sales minus the cost of goods sold will give us our gross profit. And then when we determine our gross profit, we deduct our operating expenses to give us our net profit. So let's go back over here. So once again, we headed up properly. The period ended, name of the statement, name of the company. Okay, so we have our sales. Let's say we had sales of 300,000, and we reuse our cost of goods sold figure, which is 110,000. We deduct it this time. That's why I have the angle brackets, and that would give us our gross profit, 190,000. Okay, and then now, according to our notes, we have to deduct our operating expenses to give us our net profit. So let's say we only have 3 operating expenses for this particular company. They had advertising expense, salaries expense, and telephone. So let's say those are 2,000, 30,000, and 3,000 respectively. And we total those to give us our total operating expenses. We deduct them. That's why I have my angle bracket once again. We deduct them from our gross profit, and that will give us our net profit of 155,000. Okay, so that is the end. So we did a practice run through. Okay, so we prepared those 3 schedule/statements. Schedule cost of goods manufactured, schedule cost of goods sold, and the income statement. Now, balance sheet. We didn't do a balance sheet because essentially there's really no difference. There's only like one minor difference between the balance sheet of a manufacturing business and that of a merchandising business, and that is the types of inventories they will have on hand. So as you can see here, I have 3 types of inventories listed here. So I said that the 3 types of inventory held in manufacturing businesses include raw materials, work in process, and finished goods. Okay, and compared to the Merchandising business would only hold one type, which would be the last one here, the finished goods. They wouldn't have a raw materials inventory or a work in process because the merchandising business would actually be making the goods. They wouldn't be making them from scratch. Because as we said at the beginning of the lesson, merchandising businesses buy finished goods for resale to their customers. Okay, whereas in manufacturing, they convert raw materials into the finished goods and sell those finished goods to their customers. Okay, and to close off the lesson, I have 3 review questions. So, okay, we have what is the difference between manufacturing, merchandising, and service business organizations? So, as we said earlier, manufacturing businesses convert the raw materials into finished goods, and then they would sell those finished goods to their customers. Whereas the merchandising, they buy finished goods and resell them at a marked up price to their customers. And lastly, we have the service business organizations. They do not provide a tangible good for the consumer to buy. They provide a service which the consumer consumes immediately. For instance, as the example was given before, with the hairdresser, you consume the service of the hairdresser immediately. You cannot take home the hairdresser and her talents with you to get your hair done the following week. You get it done at your appointment time. Okay? So that's the difference between those 3 types of business organizations. Now, the second question we have here is prime costs, and we want to know, well, the statement here is prime costs and manufacturing overheads are one and the same. Do you support this statement? Why or why not? So, if we review what we did before, we cannot support this statement because we said prime costs are those costs which are directly or specifically traceable to the goods they were used to create. For instance, direct raw materials, we can see, or we can, sorry, for a better word, we can trace that this lumber was used to create those chairs, that furniture, whatever have you. Labor, we can tell by looking at the timesheet or time card, whatever source document, that these workers spent this amount of time doing creating this particular good. Okay, and whereas now with the manufacturing overheads, we cannot specifically or directly trace the um, contribution of this particular resource to the creation of the goods. For instance, factory rent. Okay, we paid rent for the factory, but what amount of that rent must go to product A versus product B? We cannot specifically or reasonably trace this directly or specifically to the creation of the goods and services. Sorry, the goods. And lastly, I have here question 3 is that if we have finished goods, so given finished goods inventory brought forward is 70,000, cost of goods manufactured is 57,000, and cost of goods sold is 107,000. Can you determine finished goods inventory carried forward? Okay, and to do this, we must use one of the previous formulas that we had listed. Okay, these 2 formulas here we must use them in conjunction. So I had some rough working over here, so please bear with me with my handwriting. So F dot INV brought forward, that stands for finished goods inventory brought forward. As we said, it's 70,000 or 70K. Then we said the cost of goods sold is 107,000, and we said that the cost of goods manufactured is 57,000. Okay, so to work this out is very simple. We would use the first formula. So okay, so we said the inventory brought forward was finished goods inventory brought forward was 70,000. So we would add that to our cost of goods manufactured to give us our cost of goods available. Okay, so that's what I did here in the first line. So I have 70,000, which would be the brought forward inventory, plus the cost manufactured, the goods manufactured, and don't worry too much about this part yet. So this first part give us 127,000. Okay, so 127,000. But we know according to our second formula that once we determine our cost of goods available for sale, we must deduct our finished goods carry forward to get our cost of goods sold. But the problem is we don't know what our inventory is, so we must determine this figure. So what I'm going to transpose the finished goods inventory carry forward to the other side, and I'm going to transpose the cost of goods sold to the other side, and I'm going to change the sign of the cost of goods sold. So you can see it here in my working. So this is what I did. So if you look down here, right, this is just basically the sum of this would be our cost of goods available for sale. And I said subtract sum x, which stands for the finished goods carry forward, would give us our 107,000 as our cost of goods sold. So what I did is I transposed, carry over the x, carry over the 107,000 to give us the bottom line here. Okay, so when we subtract one from the other, we can solve for x. So that would have to be 20,000 as I have right here. So you could have done it all in one step, or you could have did it step by step. All roads lead to Rome. I think that's what it's saying is. So when we add the two of these, which would be the brought forward inventory plus the goods manufactured, subtract the cost of goods sold, that would give us our closing inventory. So you could have done it in one step. You have two separate formulas, or you could have combined the two in one step like this, or you could have done it separately. So the answer for that is 20,000. Okay, so we've answered all our review questions. Okay, so that would be the end of the lesson. Just a quick recap of what we would have done today. Okay, right, so the topic we did today was manufacturing accounts, which is the second topic on the syllabus. Subtopics we went through were distinguishing between manufacturing and non-manufacturing entities. We looked at some of the schedules associated with manufacturing accounts, and we prepared some brief financial statements. Okay, right, so we distinguish between service, merchandising, and manufacturing industries. We classified some examples here. We defined some terms and concepts associated with schedules, as you can see here. And we actually looked at the formulas associated with the schedules, for both schedules and the financial statements, at least the income statement. And then we said that the balance sheet has three types of inventory, whereas merchandising only has one, which would be the finished goods. And we reviewed. Okay, that would be the end of the lesson.